Happy Tuesday, everybody. Today is May 26, 2026, and this is your Tuesday market update. I'm back. I'm sorry about a few missing weeks as my mother recently passed away and I was away from the updates. Let's get caught up a little bit. I hope everyone had a meaningful Memorial Day weekend. Yesterday, while markets were closed, many families across the country took time to remember and honor the men and women who made the ultimate sacrifice in service to our nation. It's always important to pause and recognize that the freedoms and opportunities that we enjoy every day came at a tremendous cost to so many families. As investors return from the holiday weekend, markets are stepping back into the environment that continues to balance strong earnings growth, elevated inflation pressures, higher interest rates, and ongoing geopolitical uncertainty. Markets spent last week wrestling with a difficult balancing act. On one side, investors continue to see exceptionally strong earnings growth tied to artificial intelligence, resilient economic data, and ongoing momentum in technology stocks. On the other side, rising treasury yields, elevated oil prices, inflation concerns, and geopolitical uncertainty surrounding the Middle East continued creating real pressure beneath the surface. In many ways, it became an earnings versus everything else market. Now let's recap last week's market and let's preview the week ahead. As trading began on Monday, markets came under pressure as technology stocks weakened and investors continued monitoring the situation in the Middle East. Oil prices remained elevated above $100 per barrel, while treasury yields continued climbing, creating renewed inflation concerns. Semiconductor stocks were particularly weak after cautious comments from Seagate raised concerns about whether memory chip supply could keep pace with surging AI demand. However, investors still showed a willingness to buy leading AI and semiconductor names on weakness, reflecting how dominant the AI growth story continues to be. By late afternoon, comments from President Trump suggesting there would be no immediate military strike on Iran helped stabilize sentiment into the close. The Dow was up roughly a third of 1%, S&P down less than 1/10 of 1%, the Nasdaq was down about a half of 1%. On Tuesday, markets moved lower again as Treasury yields surged to multi-decade highs as investors became increasingly worried about inflation pressures building globally. The 30-year Treasury yield climbed to its highest level since 2007, while concerns grew that the bond market was beginning to price in a more persistent inflation environment. Oil prices remained elevated as ceasefire negotiations between the U.S. and Iran continued to show little measurable progress. Economically, stronger than expected domestic data actually worked against the markets because it reinforced fears that the Federal Reserve may need to keep policies tighter for longer. Semiconductor stocks remained under pressure ahead of NVIDIA earnings, although investors generally viewed the weakness as profit-taking after an enormous rally since late March. The Dow was down roughly 2/3 of 1%, S&P down roughly 2/3 of 1%, and the Nasdaq was down nearly 1%. Wednesday brought a strong rebound as oil prices and treasury yields both retreated on renewed optimism that the U.S.-Iran peace agreement could be close. Investors welcomed reports that negotiations had entered what President Trump described as the final stages. Heard that before. Lower oil prices immediately eased inflation fears and helped calm the bond market after several difficult sessions. Markets also turned their full attention toward NVIDIA earnings after the close, with many investors viewing that report as one of the most important earnings events of the year, given how much AI enthusiasm has driven this rally. At the same time, broader economic conversations increasingly shifted towards whether the economy is entering a stagflation environment or simply continue to run hot with resilient growth and elevated inflation. The Dow was up roughly 1.25%, S&P up just over 1%, and the Nasdaq was up roughly 1.5%. Thursday was another reminder of how high expectations have become for mega cap technology companies. NVIDIA once again delivered strong earnings and guidance that exceeded analyst expectations, but the stock initially struggled to rally because so much optimism has already been priced in. Markets also continued monitoring geopolitical headlines very closely as negotiations with Iran appeared to make progress, although several sticking points remain unsolved. Economic data overseas raised some concern about slowing growth and rising inflation pressures globally, particularly in Europe and the UK, while U.S. data remained relatively more resilient. Despite some volatility during the session, stocks ultimately recovered into the close as hopes for a peace agreement did improve. The Dow was up roughly half of 1%, S&P up less than a quarter of 1%, and the Nasdaq was up less than 1/10 of 1%. By Friday, investors appeared increasingly comfortable heading into the holiday weekend. Treasury yields eased further, and the market continued to respond positively to signs that geopolitical tensions might gradually cool. The S&P 500 secured its 8th consecutive winning week, marking its longest winning streak since late 2023. AI enthusiasm remained strong throughout the semiconductor space, with Qualcomm extending a powerful rally following earnings. Investors also broadened their focus somewhat beyond just mega cap tech, with healthcare and industrial names now showing some improved participation during the week. The Dow was up roughly 0.5%, S&P up roughly 1/3%, and the NASDAQ was up roughly 1/4%. For the week overall, markets once again showed impressive resilience despite a very challenging backdrop. The Dow finished the week up just over 2%, S&P gained just under 1%, and the NASDAQ added roughly 0.5% as investors balanced strong earnings momentum against higher yields, inflation concerns, and ongoing geopolitical uncertainty. One of the most important themes right now continues to be the relationship between earnings growth and interest rates. The market has largely been able to absorb higher oil prices, geopolitical stress, and rising yields because earnings growth tied to artificial intelligence have remained extraordinarily strong. That has been especially true across semiconductors, memory chips, networking infrastructure, and hyperscale cloud providers. But investors are also beginning to recognize that valuations have become increasingly stretched. The market is essentially assuming that massive AI-related spending by companies like Microsoft, Amazon, Alphabet, Oracle, and Meta will continue for years to come. As long as earnings growth remains strong, investors appear willing to stay patient with higher valuations. But if earnings disappoint or inflation pressures worsen further, volatility could increase quickly. Another major focus remains the bond market. Earlier in the week, the spike in Treasury yields created legitimate concern that inflation may prove more persistent than many investors expected. Markets are continuing to adjust to the arrival of Kevin Warsh as the new Federal Reserve Chair, particularly because investors remain uncertain about how aggressively the Fed may need to respond if inflation pressures continue rising throughout the summer. Looking ahead to this week, investors are returning from Memorial Day holiday to a calendar packed with important economic data, several key earnings reports, and a very busy schedule of Fed heads speaking throughout the week. On Tuesday, markets will focus on consumer confidence, home price data, and the Dallas Fed Manufacturing Index. Investors are continuing to watch very closely for any signs that higher gas prices, inflation, and borrowing costs are beginning to impact consumer behavior or economic activity more broadly. Wednesday does start to pick up significantly with Logan, Cook, Jefferson, and Goolsbee all scheduled to speak for the Fed. Markets will likely pay attention, especially close attention, to any comments surrounding inflation expectations, energy prices, and whether the Fed officials believe that current policy is restrictive enough. Thursday could easily become the most important day of the week. We will get the latest PCE inflation report, which remains one of the Federal Reserve's preferred inflation gauges, along with updates on personal income and spending, durable goods orders, GDP, jobless claims, and new home sales. Throughout the day, investors will also hear from Williams, Musalem, and Barkin. Williams recently described policy as mildly restrictive, while Musalem warned that inflation risks are beginning to outweigh employment concerns. Barkin has also acknowledged growing concern that inflation expectations could become less anchored if elevated prices persist too long. Friday remains busy as well, with Schmid, Bowman, Paulson, and Daly all scheduled to speak. Paulson recently commented that markets are beginning to properly price in the possibility that rates may remain unchanged for an extended period of time, and even acknowledged that additional tightening may eventually become necessary if inflation fails to improve. Then on Saturday, Waller will speak, and investors will continue listening carefully after his recent comments that could no longer rule out future rate hikes if inflation does not begin cooling more meaningfully. So this week really has the potential to shape the market narrative heading into June. On the earnings front, investors will continue monitoring both consumer and the AI trade very closely. Retail earnings from Dollar Tree, Burlington Stores, Gap, American Eagle, Kohl's, and Best Buy should provide additional insight into the health of that consumer, whether spending habits are beginning to shift under inflation pressures. At the same time, AI-related earnings remain front and center with reports from Dell, Marvell Technologies, Synopsys, and Salesforce. Markets are still trying to determine whether the AI build-out story can continue supporting current valuations across technology and semiconductor stocks. And beyond the scheduled reports and Fed commentary, investors will continually, of course, closely monitor the geopolitical situation in the Middle East. Any progress towards a U.S.-Iran agreement could help stabilize oil prices and treasury yields, while renewed escalation could quickly bring volatility back into the markets. So as we move into this holiday-shortened week, investors continue balancing strong earnings growth, elevated inflation pressures, higher bond yields, AI enthusiasm, and geopolitical uncertainty. That combination has kept markets surprisingly resilient, but also increasingly sensitive to any shifts in the data or headlines. As always, stay focused on your long-term plan and not just the short-term noise. Thanks for listening. I hope you have a great week, and I'll see you again soon.